Welcome to Healthcare Forward, where industry leaders, benefit advisors, and healthcare professionals come together and discuss the changing landscape of commercial health plans. Brought to you by Roundstone Insurance, the first group captive for health insurance, where smarter self-funding meets long-term savings. I'm Mike Schroeder, founder and president of Roundstone Insurance. I'm your host, Mike Schroeder, founder and president of Roundstone Insurance, and today we have here with us Lauren Gliha, the manager of Partner Solutions at Roundstone. Lauren, welcome.
Thanks, Mike. Glad to be here.
Well, before we jump in, can you share a little bit about what is Partner Solutions and, what do you do?
Great question. Yeah, so Partner Solutions is really essentially our cost containment department here at Roundstone. So we have 3 nurses who are clinical claims review nurses. They look at high dollar claims, employer experience in the claims, and make recommendations on how much we think claims are going to be. We have a cost containment strategist who is vetting potential vendors to bring in cost containment solutions. We have a couple data analysts who are crunching the numbers, and a project manager, and I'm supposed to hold it all together.
Great. And I'm sure you're doing that. So, today I want to talk a little bit about real risk and perceived risk. And
Sure.
We had a survey of CFOs recently, and in that survey, the CFOs shared that they feel pressure. I think it was half of them feel pressure to better manage their healthcare plan. And so they're taking a look, but they have some concerns. And,
Sure.
Like a lot of employers, the concern is a catastrophic claim or a large unexpected claim. And, when you step back, really almost for any employer and certainly for any CFO, they're looking for 3 things to avoid, really. They want to make sure that catastrophic claim is covered. They want to bring some predictability to the costs of their health plan. And then they want to make sure that there's not some unforeseen financial impact that they are accountable for and that they're blamed for because they went into a health plan that didn't work. So
Sure.
That's certainly their concern. And, my question is, have you seen a change or folks' concern change when they got a little more into self-funding and they learned a little bit more about it?
Yeah, definitely. I think the big, large claims are, like you said, everyone's fear, but once they learn about self-funding and particularly about a captive, they realize that there's built-in safety nets. So the captive is protecting them on a per member and a plan level. And then we have a fronting insurer for the very high dollar catastrophic claims. So once employers realize that they're only going to have to pay up to a certain dollar level of their own choosing, they can choose that level of risk, and they're protected after that. It really, I feel like, kind of takes a little bit of the stress away.
Is there any numbers or metrics that help in addressing that concern?
Sure. So I think one of the things that also makes them feel a lot better is they get this visibility into their claim data and this transparency that they didn't have before. I remember working at my previous employer, small place, 20 people. Every November, we would just hold our breath and wait for how much more we were going to have to pay. And our HR person would have no idea. She'd be sitting there saying, guys, I don't know. Could be 30%. We have no idea. We'll just have to wait and see. But I think CFOs can realize that once you have this visibility to see where your high costs are, and when you can start to do something about it, they can feel better about it. And then they can start to look at things like how much does each employee cost per year. So, we're looking here at Roundstone, as you know, at the average per employee per year cost and what the national benchmark is. And we see that Roundstone groups are performing much better.
You mentioned the word stop loss. So, stop loss is a policy of insurance. And it provides coverage against both catastrophic claims and an accumulation of a lot of claims beyond the expected amount. My understanding is the way it works is you have what they call specific coverage, which is on a per claim basis, and that typically attaches above an employer deductible.
Right.
And then you have coverage in the aggregate. So if it goes above a certain percentage of the expected claims, then the insurance company steps in. And, that obviously goes to the idea of concerns about predictability and catastrophic claims. What I'd like to do is, can you walk me through a claim example? Like if someone has a $1 million claim, what happens? Who pays what? And
Sure.
talk a little bit too, if someone, for whatever reason, we expect them to have $1.5 million of total claims and they end up having, $1.8 million, what happens then in that case?
Sure. So, as you mentioned, employers can pick a deductible on a per member basis. So, in your example, if a person has $1 million claim and this employer has selected $100,000 as their deductible, they pay the first $100,000 for that member. And then our captive covers everything between 100 and 500. So the pooled risk is stepping in there, and other employers are sharing in that risk. And then everything over $500,000 goes to our fronting insurer or reinsurance carriers to pay over that amount.
Yeah, so $1 million claim on an example, the employer, I guess, pays that first.
Yeah.
It's not like they pay $1 million.
Right. They pay $100,000 and they don't have to pay and wait to be reimbursed.
Right.
We can advance it for them. They don't have to put the cash out if they're not comfortable doing that.
Oh, so there's some cash flow benefits under the policy.
Certainly, especially for those. Our sweet spot is really 50 to 300. So for those smaller groups, 100 employees, we realize coming up with $1 million could be tough.
Let's talk a little bit about pricing that risk and underwriting of that risk.
Sure.
Is it any different than like you would experience in traditional fully insured?
Sure. As I was saying before, in the fully insured market, you're often kind of going in blind to your renewal. So here we're really looking at very specific group claim history and digging into the large claims and the monthly claims versus fully insured world where you're maybe more just looking at the demographics of a group and only basing it on that. And I think, obviously I'm not an underwriter. You can probably comment more on our underwriting process, but I feel like Roundstone is pretty unique in that we offer access to our underwriters. So if groups want to understand their pricing of the risk or how we got there, we can offer that, and they can come in and kind of get a real kind of walkthrough of it.
Yeah, I'm not an underwriter either. I like to play one on TV, but
I play a doctor on TV.
Yeah. So, but anyway, the thing that I like about the self-funding and what I share that is, I think, really different than what you experience in a traditional fixed cost model is we're underwriting or pricing for the risk that we feel is going to happen in the future. Mm-hmm. And so if there's been a past claim in which caused premiums to go up, if that claim no longer is present on the plan for whatever reason, we're not pricing for that. And that differs very much. Like, I like to ask the questions a lot of times to employers, has your insurance company ever lowered your price? And they think like, oh, that's a crazy question. But it really should not be a crazy question, because if your plan is not as full of these claims that gave rise to the higher pricing, then you shouldn't be paying the same. And, the other saying I like to share, and I've mentioned it all the time, is, you should pay for what you deserve. And so if you have people that are claims that are no longer on your plan, you shouldn't be paying for them. And I think that's a real differentiator and attractive part for self-funding.
Absolutely.
Yeah. So let's talk about what you've seen with employers when they have that aha moment. Oh, okay, this is not maybe as risky as I thought, and the light bulb goes off, and they basically recognize, wow, there's some real benefit to self-funding. Can you share a couple examples of that?
Yeah, I can think of two different scenarios. So certainly there are the instances where there can be these high dollar claims, and I think the aha moment comes in when they realize they don't necessarily have to front it with the cash up front, and also when they realize how detailed Roundstone is in our review of these claims. So we're catching duplicate payments, we're making sure drugs and high cost treatments are priced appropriately, we are making sure people are eligible for their plan, and that we're paying claims appropriately the way the group designed it. So there's some definite advantage there. And I think the second aha moment is that Roundstone is not keeping any unused claim funds. We are actually redistributing unused premium at the captive layer. So when I started at Roundstone, I was very briefly an account manager, and the best part was getting to email or call up a group or a broker and say, hey, you're getting a percentage of your premium back. So even though this is a very low fixed cost option to health insurance, you're still able to have an opportunity to get some of that fixed cost back.
Yeah, when you return money, that's the aha, that's the light bulb going off.
Exactly.
One of the things that I recall for an employer where they really recognize the power of self-funding with a shared risk pool like a captive was this client who had a very large case. It was like a $2.5 million case. And both the advisor and the employer fully expected that their renewal was going to be really difficult, that they would get a double-digit renewal. And they didn't. That renewal for that client that year was, in terms of what we thought the cost would be, was only going to be going up like 6% or 6.5%. And that's when they recognized, like, oh, all of this claim is not falling on me. And if the claim is not going to happen next year, my price is not going to reflect that claim. We're not trying to recover those losses. And, yes, the reinsurers paid a lot of money in the past year, but they're not really trying to recover it next year. And lo and behold, I have a $2.5 million. I mean, their loss ratio was probably hundreds of percent, but they had a 6.5% expected cost increase for the following year. So that, to me, that story dates back more than 10 years, and that's probably my aha story with the client. So
absolutely
similar to what you were sharing. So let's talk a little bit about data points and comparisons that you talk about with clients and folks that says, hey, self-funding is really valuable. You have any of those you can share?
Yeah. Okay. Yeah. So I mentioned earlier that at Roundstone this year, we're really looking at the per employee per year cost for groups. So there's a national benchmark by an organization called Mercer that did a study that said on average in America, employers spend $16,000 per employee per year. At Roundstone, if you're using a preferred vendor like our in-house TPA Bywater, you're spending closer to $11,000 per employee per year. So it's obviously big savings.
So that helps with the whole perceived risk versus real risk, and the real risk is actually lower than staying with what you've been doing.
Absolutely.
Yeah, by a good $5,000 per employee, right?
Yeah. That's
pretty real. Let's talk a little bit about cost containment. I know you manage a lot of that. You have a person who vets cost containment. And, we're trying to manage the cost down. Are there any that you like or you're seeing there's an increased popularity among employers?
Yeah, I think there's a couple different things that are trending. I think being upfront on chronic conditions is really important, so those don't lead to those high dollar claims later. Vendors that can manage diabetes for patients in that population are really big. We're working with a vendor who we've recently brought on board called Omada that is a digital solution there. So it's very user-friendly, easy to get employees enrolled, and they're very proactive at getting people involved in managing their diabetes and making sure they have affordable supplies. Another trend is care navigation, so getting members used to searching for high quality, low cost providers and having a resource to do that and go on and very easily, again, a digital way to type in and say, I need to go to the dermatologist. What's the best, most affordable person in my area? And getting employees to have a little bit of skin in the game, so to speak, on saving in that way.
I know we're going to be having another podcast episode on really focused on cost containment, but direct primary care, I'm hearing that an awful lot.
Yep.
Is that something?
Yeah,
you're seeing?
I think primary care, again, just like chronic conditions, is a huge benefit to saving later. And direct primary care is a really great way to make it easy for members to not have to wait. At a large hospital system, you could wait 5-6 months to see a primary care doctor, and with a direct primary care solution where it's very easy to access either by phone or in-person visit your primary care physician, you're going to get ahead and catch those really severe conditions.
I find primary care really interesting because I think it is clear that within the system itself there's a breakdown, and to me it's very similar to teaching. Like there's not enough teachers, not enough people going to teaching. More often than not, it's economic. They're just not paid enough. And then the same with primary care. There's not enough primary care docs. I think everybody would admit or recognize that long-term health is supported and promoted by a good primary care relationship. So I'm very encouraged by the work Roundstone's doing with direct primary care. I'm very encouraged by the navigation tools that help in getting folks connected with a primary care, whether it's virtual or otherwise.
Yeah.
And I think that has the opportunity for employers long-term to really impact their costs. So that's exciting. Talk about digital care. I know
Sure.
we've got a relationship with the Sword Health.
Yep.
Which is, I believe what is that, MSK?
Yes. So musculoskeletal conditions like, people who are going to need joint replacements or who are in physical therapy, expensive back surgeries, getting a digital physical therapy provider can really get people in as sooner and make it easy for folks to do at home. So if you're going to log on every morning for 20 minutes and do your physical therapy, much more likely to do it than if you got to skip work, drive to the appointment, and this can prevent these replacements and these surgeries. And so again, making it very easy and like integrated with the health plan from the beginning makes it much smoother for members and easy for them to use.
So your department's really about reducing the risk, reducing the costs, and finding ways to. So an employer that's concerned about risk or concerned about predictability of costs and having a bad financial outcome you're kind of their best friend, I would guess, right?
Yeah, we like to think so. Reducing risk and doing it in a way that won't disrupt the member. So that's what we don't want to do that. We want to control costs and make it easy for members. And I think that's the importance of our vetting programs. So we're really digging in, getting to know these vendors, learning about not only their pricing, but their service, how they talk to customers, and making sure that they're a good choice for employers in our captive.
So I have a question. I think you've shared, we don't keep any of the savings. So why does Roundstone do this, or why do they care about the experience that an employer has and the opportunity to mitigate costs or control costs? I mean, what is it that's causing us to sort of align ourselves with these employers and the CFOs?
Yeah, well, I think, obviously, our mission is to make healthcare affordable for everyone. And at the root of that, there's patients on the other end of this. So we want people to have a smooth experience, and we want to get ahead. We want to be proactive. The more you can be in charge of your healthcare before you need it, the better off we're all going to be.
Here's a interesting question that someone shared with me. Like, if there's one myth about self-funding that you could basically demystify or debunk, what would that be?
Yeah, I would say one of the biggest ones is that I would assume a lot of employers believe they're too small to self-fund. And, as I said before, our sweet spot is really 50 to 300 employees. So, I think lots of people think of Walmart or Amazon when they think of self-funding, but you don't have to be anywhere near that big to make it work for your employees.
That's a good one. So we started talking about real risk and perceived risk and, obviously the importance of stop-loss coverage. That's critically important to recognize that both from a cash flow and catastrophic claim, you're not on your own. And then we talked a lot about, what we do to even mitigate those risks more. And so at the end of the day, would you tell an employer that the real risk is less than maybe what he might think?
Yeah, absolutely. Like we've said, there's built-in safety nets. And if anything, you're reducing your risk by doing this because you can be more proactive, you can see the data, and you can offer your employees a better experience. And I think at the end of the day, that's really what it's all about, is making sure that you have, good benefits for your employees.
One of the conversations I like is the question of, for an employer, what's riskier, having access to what's driving your cost, having resources like your team to help manage those costs effectively, having the money sent back when you don't spend it. Is that riskier than having an insurance product where you have no idea what the cost is going to be, how much it's going to increase, or why? It seems to me the latter is a little riskier.
Agreed.
So in terms of managing costs and managing risk, certainly stop loss and certainly cost containment. But can we chat a little bit about the importance of working with an effective TPA. Roundstone's TPA Bywater, you mentioned, has a lower per employee per year cost. Why is that, and how important is it to managing costs to work with the right TPA?
Yeah, it's very, very important. So I mentioned earlier that we vet a lot of our partners and score them. So, when we're looking at third-party administrators, we're looking at things like the quality of the claims that they submit us, and are they including all of the information that we need to review them. We're looking at, the networks that are available out there for them to be able to access. We're looking at how cooperative they are with our operations team. How willing are they to, implement these cost containment vendors that are really going to produce savings. And so working with a TPA like Bywater is really great because, as we mentioned, we have these integrated cost containment programs like care navigation and chronic conditions that are really getting ahead of those costs that could be coming in the long term. And we're filing timely claims, detailed claims that are very easy for our claims adjusters to review and go through and really kind of pick out the detail as needed. And it's just important, really, because if you can't file claims timely, that's not going to work out for anyone.
Right. So you hear me say a lot, we actually look at claims. And I know prior to taking over the management of the Partner Solutions team, you managed one of our claim functions. What do I mean when I say Roundstone actually looks at claims? Yeah,
what you were saying is really, in a self-funded model, the employer is designing what they want to cover and what they don't. And so what we're really doing is making sure that the claims are paid according to the way they've intended them to be paid. And so what no employer is intending is for a claim to be paid twice, or for a claim to be, recently I was working with on a really high dollar claim in a situation where the person was hospitalized for a very long time. And so when that happens, the provider bills intermittently. And those claims were paid along the way, and then the provider billed for the entire stay at the end of the stay. And so we caught that, and we didn't pay it twice. And so in another situation, may that have been paid twice if someone wasn't looking? Could have been. And so we're digging into that kind of thing.
I'm curious, how much was the dollars at issue there?
We're going to save about $1 million that we were duplicated in. About $1 million was filed to us twice.
So if you picked the wrong TPA, or you're with a traditional insurer, someone could pay $1 million bill twice?
I wouldn't have believed it a couple of years ago, but I saw it happen with my own eyes.
Wow, that's great. So obviously that employer's pretty happy.
I'd say so.
Yeah. The whole claim management, claim payment, that obviously plays into perceived risk and real risk. And explain a little bit more maybe about how paying attention to claims can really help manage the risk.
Yeah. So like you said, we're not going to, on a renewal, we don't want to penalize someone for something that's already occurred and won't occur again. So along those lines, once a plan year's over, we want to be sure that what has been paid is appropriate and accurate. So again, duplicate claims, overcharging on high-cost treatments. We compare every high-cost drug to the actual average wholesale price, and we're not afraid to question if that's too much and negotiate and do things with the provider that can bring down that cost. So again, that all helps the risk.
And I guess that's the whole alignment too. Mm-hmm. We're working on behalf of the employer. I'm not sure you were involved in the one claim that I recall where the provider kept raising their price every month or every week maybe when the patient would return, and the price kept going up pretty dramatically. Yeah. And then we were able to reach out to that provider and basically say, hey, we see what's going on here. Let's get this more in line with what you should be charging. Exactly. But again, that only happens if you have an insurance company and a claims adjudicator who's aligned with you. Would you agree with that?
I would agree. And in that situation, I think that provider was in a remote area, not a lot of competition, and so they maybe in other situations were able to bill that way. But again, we were looking close enough.
correct me if I'm got these numbers right, but didn't they start off at something like $1,500 an infusion, and it went up to like almost $30,000?
I actually think it was more than 30,000. I think they got up to somewhere around 40, and we ended up landing and negotiating somewhere around 10 per treatment, and again saved the group almost $1 million.
$1 million savings. Boy, that's some inflationary cost there if you go from a couple thousand up to 40 or 50. So
yes.
And if you're doing that, were they doing that weekly or monthly?
Weekly.
Wow, so that's a big claim.
Yep.
Yeah, that's why they're saving them $1 million. So.
Exactly.
Well, that's good. I mean, obviously, it seems to me you have lower risk if you have an insurance company watching out for you as opposed to one who isn't paying attention and your costs just keep going up.
Absolutely.
All right. Well, Mr. CFOs, I guess that's real risk and perceived risk, right?
Sure is.
Well, Lauren, thank you for joining our podcast today. I know our customers really appreciate the work you do for them and controlling their costs. And if folks want to learn more about what Roundstone does, reach out to our sales folks. We call them regional practice leaders, or RPLs, and they can direct you in the right place and take next steps. And I would also encourage you to tune into our next episode of Healthcare Forward, where we will be talking with one of our advisors, Jay Booth. Thanks for joining us today.